From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, this is the COB, all the stuff you need to know in the day in business and markets. I'm Kyle Rodder. It's great to have your company as we wrap up the day here, and let's look at what the market did. Up by 0.65% by the end of the day's trade. So it's really a nice one-way trade there for the first 2 hours of the session. Flatline for the most part of the back end of the day. Nevertheless, held on to the majority of the gains, and not such a bad thing considering that we were expecting a decline at the open. At least that's what was being implied in SPI futures. So let's get across some of the news. Actually, sorry, before I do, get across some of the areas of the market that were moving things today. And miners actually performing reasonably well despite continued uncertainty and volatility around the outlook for China. But we saw a lift in iron ore prices as they continue to defy gravity, it would seem. And as you can see there, strength across the board when it comes to those big miners and the energy names as well. The noteworthy one there, Fortescue Metals back above $21 per share, $21.13 to be exact, and 3.35% higher. But where was the weakness? Well, it was in tech. There's a few reasons for that, and Wisetech Global is probably the biggest one, down 19.26% after its results. We'll pick those apart shortly, but it's back down to $69.78 a share. It was at $88 at different stages to start this week, or perhaps really at the back end of last week. But the weakness in tech across the board, Block, Technology One and Altium all lower for the day. But let's get across some of the results now, and Woolworths has reported a near 5% rise in full year profit to $1.6 billion, helped by elevated shelf prices on the back of rising inflation and increasing normalisation of customer habits. The result was below analyst estimates, the impacts of inflation and moderating consumer demand as reasons for more careful customer demand and softer profitability. CEO Brad Banducci said the business expects inflation to ease in the year ahead, but remain elevated in some package categories. The company will pay out a 58-cent final dividend that's up 9.4% from a year earlier. And there you can see that's how the shares traded today, finished higher by 3.81% to $37.56 per share. Also reporting today, Woodside Energy, and its first half net profit rose some 6% to $1.9 billion, a miss on market forecast, but underpinned by resilient LNG prices and upbeat production levels following full contribution from BHP Group's petroleum assets. Oil and natural gas prices, which soared to record highs last year in the wake of the Russia-Ukraine war, lost momentum in the first half, but remained above the long-term average price levels. Shareholders will receive an interim dividend of 80 cents per share, short of consensus estimates of 86 cents per share. The company continued to progress work at its major facilities, with the $12 billion Scarborough liquefied natural gas project now 38% complete, with first cargo shipments targeted for 2026. The result comes as Woodside and Chevron are locked in a dispute over pay and job security with about 700 workers at 4 facilities in Australia. These plants produce more than a tenth of the world's liquefied natural gas. Okay, go to Domino's Pizza now. It sliced its dividend by 30% as full year net profit slid 60% to $67 million due to weaker orders, but has flagged an improvement in earnings in the year ahead. Domino's say margins and earnings were hurt by the decision to raise prices in order to protect it against extraordinary inflation, which led to fewer meals sold.
Inflation we took, particularly in Europe, was incredibly painful, and we didn't handle it as well as we could have. But 1 year later, we especially in Europe and Australia, New Zealand, we're enjoying records, we're enjoying strong sales, and I think shareholders were looking for that. Is that building it first with the customer. The customer rejected some of our early ways that we passed through inflation, and for example with our delivery service fee, which we've now unwound. But now they're enjoying the stability in our pricing and the new products that we're launching. The area that suffered the most was delivery, and delivery is really rebounding quite strongly.
Okay, and you can see there Domino's share price surging today, up 11.14%. So a cracking result, I guess you could say. All right, IDP Education shares were in focus too, eyeing the best day in a year after the company reported record revenues in FY23 and said that it will pay out a larger than expected dividend for the full year. Revenues came in line with expectations at $982 million, with profits rising 45% to $148.5 million. The business says the result was driven by strong student placement volumes, growing 53%, primarily driven by the Australian market. The company provided little guidance and did not comment on the impact of Canada's decision to end the company's effective monopoly for English language tests. IDP will pay a dividend of 20 cents per share, taking the full year dividend to 41 cents. Also in the energy space today, Santos has reported a 32% fall in first half net profit on the back of lower average price of LNG and a decline in production and sales volumes across its portfolio. Underlying profit, which strips out some one-off items, fell 37% to just over $800 million US. Still, shareholders will get an interim dividend of 8.7 US cents a share, up 14% on the previous corresponding period, with the company retaining its annual production guidance. On its troubled Barossa gas field project, where drilling operations remain suspended, the company says the project is still on target to start production in the first half of 2025 and will be within current cost guidance. Shares today finishing down a fraction by 0.51% and trading at closed at $7.74. And in some other news now, we spoke about Wisetech Global. Its shares did take a significant hit, off by more than 19% by the end of trade, as it missed market estimates. The company raised dividends after posting a 9% jump in profit to over $200 million. Revenue was up 29% to almost $820 million. The company declared a fully franked dividend of 8.4 cents, up 31% from a year earlier, but was very disappointing in terms of the guidance, missed considerably in fact, so that's why the share price fell there. In other news, Corporate Travel's net profit was $77.6 million versus $3.1 million. Revenue was up 73% to over $650 million. The company declared a final dividend of 22 cents per share and expects to deliver a record earnings in FY24. And meanwhile, and last but not least, National Storage REIT posted underlying earnings of over $140 million, up 12%. Revenue was up 18% at $330 million. Net profit was down. And here are how those shares performed. As we said before, Wisetech taking an absolute bath. Corporate Travel also lower. National Storage, however, edging up, finishing the day's trade at $2.27. Well, the stock of the day was Domino's, one of my personal favourites, I have to say. So here's what our guest had to say about the company.
Really hear anything that alarmed me, so that was good. But, in particular, that answer that he gave you around, it was a really good question you asked about the margin thing, and I didn't really think his answer really answered the question.
Yeah.
All I got was, our competitors are now starting to do it. But again, to my point before, what's the long-term strategy? This is all short-term stuff. So good interview from you, but it doesn't change my point.
But if you can order good pizza or bad pizza and it gets delivered, which would you rather order?
I think Henry's meant to say that, he prefers perhaps a more premium type of pizza, but he's a man of, very fine taste, of course, as we know, but maybe not so enthusiastic on the stock there, despite the fact that it was up 11% today. But maybe we'll get a view on that now from my guest for the COB, Scott Phillips from the Motley Fool is standing by. Scott, thanks for jumping on today. It's really great to see you, of course, in this very busy time of the year. Domino's Pizza, we'll start there. It was our stock of the day. Do you have much of a view on the company? Because it really seemed to be more of a relief rally than anything else that, at least the last 12 months are unlikely to be replicated in the next 12 months.
Yeah, Kyle, g'day. I do have a view, mate, because I own the shares. Let me disclose that up front. So I was a pretty happy shareholder today, quite honestly. It's funny, when a market's really on tenterhooks. We've talked about retail a couple of times, mate, the last couple of weeks, and I'm going to go back there because, the numbers were terrible, and we kind of expected them to be terrible. What the market loved was the first 6 or 7 weeks of this new financial year. We've actually seen a really nice uptick in same-store sales, up more than 6.5%. And so you what's really important for all investors to be thinking about whenever you think about anything that's related to discretionary spending at all is what the last 2 years, 2.5 years have looked like. You know, Domino's came off a remarkably strong year because we're all locked at home. So what did we do? We ordered pizza. When we go out again, went to cafes and restaurants, ordered less pizza. No surprise there, right? And so that's kind of known by everybody. But then it comes down to, okay, well, how do you then model that? What do you assume is happening or not happening? What allowance do you make for that versus business as usual? And I think when the market's kind of freaking out about that, you do see share prices drop because no one's really sure. And I think it was, you know, the numbers were really ugly. Don Major was pretty clear about what the company had got wrong. But it was that combination of some job cuts, which the market always likes, a bit macabre, but it is what it is. But also that return to same-store sales growth and pretty strong growth too. Now, it's only 6 or 7 weeks, so take it, you know, with as much salt as it needs to be. But I think to the sense the market was kind of saying, gee, this could get worse. Some green shoots, we haven't used that phrase for a little while, in Domino's numbers. We saw the same, by the way, in Adore Beauty, which was out today. I own shares in them as well, sorry. But you know, the kind of both those businesses getting back into growth and kind of having the same style of kind of, you know, last year, this year story of, you know, it was tough last year because the year before was great. This year, it seems both are getting back into growth. Now, I don't want to draw too long a bow or make too strong a point here because they could fall off a cliff as soon as rates keep biting, as soon as inflation keeps going up, as soon as the economy continues to cool. But it is worth noting that there is a really significant potential for these businesses to be undervalued, underappreciated right now. Again, I own the shares, so maybe I would say that. I've owned them for a long time, though, by the way. So I've been through the highs and lows. We'll see what happens next.
Yeah, I wanted to ask a question just in terms of the strategy too, because I'm a pretty, when I'm feeling a little bit more loose with my diet, perhaps, pretty an avid consumer of Domino's pizza, especially when, you know, obviously things got a little bit expensive just everywhere over the last sort of 12 months or so. And it seemed to me that, the prices rose, but they didn't rise quite as much. They still sort of, I suppose, price themselves at a pretty reasonable price point. And my assumption was always that they were trying to protect brand equity, perhaps more than their margins. And maybe the big bet now is that effectively costs start to moderate a little bit and margins can sort of stabilise. I mean, is that kind of the big question about the valuation for Domino's going forward here? Is that if, you know, basically costs can start to come down, they don't have to sort of obviously be put into this invidious position of, you know, potentially having to raise prices on a effectively discount product?
Yeah, mate, you've nailed it. And this is exactly the question for Domino's and for its shareholders is, you know, is Domino's a relative purchase or an absolute purchase? And what I mean by that is, if everything else goes up 10%, Domino's goes up 10% as well, it's still, you know, on a relative basis, very affordable, very, you know, a very easy meal, particularly for a family, get delivered, nice and simple. We've had plenty at our place too, don't worry about that. Or is it an absolute price, i.e. under 5, under 7, under 10, under 12? Where those prices creep up, you start to say, well, I'm not going to pay that much for Domino's. It's kind of one of those, a bit like petrol or dare I say the price of a schooner of beer. I mean, whenever you started drinking, you kind of remember what the beer price was. When you started driving, you remember what you used to pay for petrol. And everything kind of feels expensive relative to that. So if it is an absolute price, i.e. over a certain price, I'm not going to buy Domino's. I'll either get the more expensive stuff or give it a miss altogether. Then Domino's is in a world of pain. If they can justify a relative price, yeah, we're more expensive, but hey, cheaper than going out, cheaper than a cafe, cheaper than more expensive pizza, then on a relative basis, and again, remember, wages are increasing, not fast enough, but they're going up, there is some opportunity there. How discretionary is it overall? Who's eating it? Are they trading down to save a few bob, or are they cutting it out to save a few bob? The way the customer groups change over time really will tell. In the medium term, mate, what the future looks like. I've got to say, in the long term, you know, a long-term investor, I'm looking out, I don't know, enough years, how many years you want to pick, 5 years, and saying, well, isn't Domino's a bigger business than today in more countries, with more stores, with more sales? I think, again, anything's possible, but I think the answer is a pretty clear yes to my mind. If that's true, then I don't think you have to imagine too much to be buying at today's price. And that's been my fundamental approach the whole way through, is not I'm buying because I think in 3 months' time this will change, or 6 or 12 months, but I think this is a high-quality business, run well, with some mistakes, and they've absolutely admitted that. But they corrected quickly. That's the other thing a lot of businesses don't do, is they stick their heads in the sand. So, you know, again, I'm a fan of Domino's. I'm a fan of the management. Don't mind the pizzas, as I said. But I think that the business opportunity is still ahead of it. And I think to the extent it can capitalize on that, it'll do pretty well.
All right, so that's Domino's there. Let's keep moving on to some of the other results today. Woolworths was one that, well, I mean, it was sort of a tale of two supermarkets potentially in the last 24 hours because from what I saw, there was a similar set of results effectively there when it came to Coles and Woolworths. One fell, one rose. Again, I wouldn't want it to try and make too much sense to perhaps the madness of crowds, but what did you think of the Woolworths result there? Because again, I get to think the stock up 4% by the end of the day's trade.
Mm-hmm. So let's start with the madness of crowds, mate, because I thought the same. I thought, wow, that's a good jump for Woolies. I better check. Turns out it fell in the last couple of days on the back of the Coles result.
Yeah.
So the share price is now back to where it was on Monday. So on one level, we're like, okay, well, you know, it gave a bit up yesterday, got it back today. Today's number isn't so much about the result, but I think, frankly, what investors feared based on the Coles number. So, you know, good news for Woolies shareholders, good news for the company. It managed to justify investors' hopes of 48 hours earlier. Just the last 24 was a tougher ride because of that Coles result. Sales up a reasonably similar amount to Coles, which is interesting, mate, for Woolies. So you've kind of got this interesting below-the-line story. You know, gross margins, cost doing business, Woolies profit up meaningfully because of the removal of those one-off COVID costs. And again, I'm a broken record, mate. I'm going to be for the rest of this earnings season. You've got to really look through those COVID numbers and say, what is the underlying earnings power? What is the underlying growth? Not the one-off rises or falls because of what changed year on year, as we saw with Domino's, as we're seeing with Woolies. Woolies obviously not on a volume line, although they did pretty well to get those mid-single digit growth numbers, given a lot of us did actually buy more from the supermarkets while we couldn't eat out. So that's probably a positive, but the removal of those one-off COVID costs make the growth look really impressive at 15% at a profit line. But the reality is that's, again, it's not going to be repeated. The good news is the cost came back out, so shareholders should be pretty happy with that. Good cost control from Woolies. They are one of the higher quality businesses on the market, in my view, in terms of the way they're run, the brand presence and the customer loyalty. So they did a really nice job of making sure they kind of cut the fat and got back to business as usual. Pretty good set of sales results. Still an inflation challenge in terms of input costs, we know that, but getting it done in a way that, unfortunately, for Coles shareholders, they couldn't do yesterday.
Yeah, absolutely. Okay, what about IDP education? We often sort of bemoan the fact that there is a lack of, you know, true good quality businesses on the ASX that, you know, aren't effectively, you know, obviously banks and miners, what have you. And I mean, for a little while, IDP education was identified as one as being, well, let's feel good about that company because it's selling a product that seems to be, you know, genuinely good and doing it in a fairly effective way. Been a tough 6 months. I guess we're all asking whether we sort of have reached an inflection point here potentially. I don't know if you own the stock or take an interest in it, but did you take much away from those IDP numbers?
Yeah, this is one I don't own, so I can talk about without concerns about bias. I think the IDP number result was pretty good. The growth was pretty good. As you mentioned in the intro, mate, they didn't talk about the Canadian change of rules there. And I think that is... It's tough being an investor, right? And when you look at these sort of businesses, you love the fact they're growing. But I'm always reminded of the old Jeff Bezos line for Amazon, your margin is my opportunity. It's not quite that for IDP, but when you've got a monopoly or when you've got a saturation, think of Telstra in the old days when it was 100% of the telco market, it was only downside from there. Now, I'm not saying that for IDP at all. What I am saying, though, is it is reliant to some degree on the contracts it has, the quality of the brand of testing that it does, and the way governments and other institutions are prepared to recommend, use, and support IDP. Now, if that continues, then this is a great business because it's super scalable. The growth they get can be really, really impressive, and the sky can be the limit. The flip side, of course, is like in Canada, they say, well, anyone can do this now, or yeah, yours isn't that much more special than anybody else's. Now, shareholders will absolutely be yelling right now saying, yeah, it's different for this, different for that. I'm not suggesting objectively even that it's necessarily better or worse. What I'm saying is subjectively, based on the government, the institution, the people taking the test, once it becomes more commoditized as an offering, then that advantage disappears really, really quickly. And so that's kind of been my concern on IDP. I'm not entirely sure I have a very strong handle on why they couldn't possibly be not beaten necessarily. Again, they don't have to lose anything, or they don't have to lose to a competitor, but losing some of the market to a competitor is enough to really undermine some of that operating leverage. So I like the business. I want it to succeed, as you say. Too few global players on the ASX, and this is one that's getting it done. But you just got to ask yourself, if you're not sure exactly why it'll be able to withstand potential competition writ large, then be prepared for a range of outcomes that may include at some point maturing or simply an opening of competition. It's not cheap enough for me at the moment, mate. It's not a recommendation of mine, but really great to see the numbers, and we couldn't have asked for more in that growth number presented today.
Yeah, they keep talking about that moat, but one thing's it's it's all good and well until someone builds a bridge, right? So we'll see if they can
It really is.
manage to sustain it.
Yeah, that's right.
I get the sense this isn't perhaps up your alley, but I have to ask about it because it was the biggest mover of the day. Wisetech down 20%. I mean, I've been watching it for the last 3 or 4 months as it surged. Seems to be a bit of a thematic and momentum trade. Speculators always seem to drive things at the margins, of course, but we're off 20%. Disappointing guidance. I mean, is there anything that you took away from it other than, obviously, well, you just got to make sure you're sober before trying to chase rallies?
I love that, mate. You've probably answered the question for me. I do keep an eye on it, mate. Yeah, it's a really impressive business, and this is one of those situations, a little bit like corporate travel. I own shares in that, by the way. And when you do great but not quite great enough, the market really takes the long handle to you, and the companies are responsible to some degree for creating expectations. On the other hand, you can't blame them if the market gets carried away. I don't know what more they could have done. Revenue up 30%, EBITDA up 20%, NPAT up 30%. And you can't say, okay, well, maybe it's the outlook. Then you look at the outlook numbers and they're saying, well, hang on, we're expecting 27 to 34% growth in revenue, EBITDA growth of between 18 and 27%. I mean, these are really, really impressive numbers. Not as much as the market expected, as you say, which is what hurt corporate travel and a couple of others today. But you got to ask yourself, man, speaking of being sober, what were people expecting, and what would you put effectively, if you're saying that the price is now 20% lower because it wasn't more than a 27% profit growth projection, you ask yourself, what were they expecting? What were they hoping for? And how reasonable was that? Now, again, it's not the company's fault. Investors are entitled to do whatever they want. If you're a shareholder, you probably got caught up with the good news and maybe hoped that the market was right. Sometimes you get a bit of a shock like today with Wisetech. Mate, I don't know, a great result. As a business execution, this is as good as you could expect. The growth into the future, I think, is very, very reasonable. Of course, more is better, but I'll tell you what, if you're disappointed with a profit growth of somewhere between 18 and 27%, you're a hard marker. You probably paid too much for the shares yesterday and the day before, and as you say, mate, it's been running up for a while. But I don't know what more the market really should have expected. I think there was a lot of hubris in the share price.
Yeah, definitely. It does remind me of the sort of trolls during that sort of everything bubble we had at the start of the pandemic. Why did so-and-so stock rise 30% yesterday? Oh, of course, the future value of their cash flows jumped by that much in that time. So it's one of those things. But
spot on, mate.
Anyway, Scott, thanks for jumping on and running us through what has been a big day in corporate results. Hopefully we'll chat again soon. Scott Phillips there from Motley Fool.
Look forward to it. Thanks, Kyle.
Thanks. Okay, let's get across the leaders and laggards now, and we'll just get a sense of what has been moving today. And well, we spoke about Wisetech being one big name to move. It was down by 20%, which we'll look at in a second. But the big movers to the upside, Domino's and IDP Education, really leading the market. They're up 11 and 10% respectively. Iris bouncing back after a horror couple of days, maybe. Someone somewhere out there finding value and a silver lining in those results that we received. I think it was on Monday now. Let's go to the laggards, shall we, very quickly. And we just spoke about Wisetech, off by almost 20%. Iluka Resources also struggling. Nanosonics, another in the doldrums, down 9%. Magellan, off by 8% too. And corporate travel, we were just talking about that very briefly with Scott as well, off by 6.4%. All right, quick recap, or actually I should say preview of what we've got coming up. Oh, actually, sorry, almost skipped the small caps there. We'll quickly peruse those and see if there were any major movers in the small cap space. 4D memory is up 96%. So I'm going to Google this right now because I don't keep too close tabs on the small cap space. But we'll see what that could potentially be behind that move, because that's a doubling in your investment if you've just if you are a holder of it. And semiconductor storage company has released better than expected analysis results. So there you go, up a whopping 96% today. So if you are interested in that, give it a Google. I'm just funnily enough jumping on the Motley Fool no less now to get across that information. But there you go, 4D's memory, 40S up by 96, almost 97%. Laggards in the small cap space, there you go. A few fairly significant falls, I suppose you could say. Always big moves in the small cap space. Okay, now let's just take a very quick look at what's coming up this evening. Earnings, Nvidia, going to be huge. I say this tongue in cheek, of course, but can it replicate last quarter's results with a 30% post-market rally. I dare say that's probably unlikely, but it's turned into a major macro risk with so many different threads to pull from that results, just not applicable to its earnings, but the semiconductor industry, US-China geopolitics, geostrategy, just in terms of the global growth pulse, it's all going to be there, the AI theme as well. We'll also get some global flash PMIs, US new home sales as well, will be interesting. And tomorrow, a quick glance at what we've got coming up. Qantas, South32, Domain, Whitehaven, Lavisa, all reporting amongst, well, a handful of others, it has to be said. Another Super Thursday. XDiv, also Endeavour, and JB Hi-Fi. So keep an eye on those two companies if you do own them. And, well, perhaps perplexed by any kind of sell-off that you do see tomorrow. But it's been an absolute exhausting day, it has to be said. Very, very busy indeed. So we'll wrap it up there, but we had a lot of great content. So make sure if you want to catch up on everything, check out our website and app. In the meantime, rest up, have a great night, and we will see you again tomorrow morning.